Hello and welcome. You are watching Too Sharp with ET. I'm Nisha Poddar. Now, the two important picks for today are that the Indian markets, they plunged today, and the positives for India amidst the global chaos. So the Indian market saw over 12 lakh crore rupees of value wiped out as Dalal Street sees red. Indian benchmark indices fell off a cliff. Sensex lost 2,200 points at close. Nifty crashed 742 points, a fall of over 3%. But this close was far better than the trading day plunge as last hour of trade saw recovery from the lowest points. Investors' wealth took a massive hit today and the pain was across the board. All the sectoral indices ended in the red, with metals, real estate, autos, financials, and IT being the worst hit sectors. Big boy Reliance Industries touched its 52-week lows, and its market cap has dropped 2.26 lakh crore rupees in just 6 sessions. Tata Motors dived 10% after JLR has halted its US shipments amidst the Trump's fresh tariff war. And it wasn't just India when it comes to markets. Hong Kong crashed 12%, Taiwan 10%, Nikkei lost 8%, while the European markets hit 16-month lows. Germany's DAX plunged 10%, France's CAC dropped 6.6%. Oil prices slumped to 4-year lows at $63. Bitcoin lost 10% in 24 hours, and don't really expect Fed to rescue anytime soon, as Fed chair says that it's too soon to act, given the sheer scale of Trump's tariffs. Now let's take a look at how much of this market crash was sentiment-driven. Let's also focus on the positives for India amidst the global chaos. Even as markets bleed, India stands on relatively firm ground. Now, the top fund manager Prashant Jain, as well as some of the new reports like the CRISIL report, highlight why the investors should stay calm and look at the large caps. First, limited exposure to the US shock. Goods exports to the US equals to only 2% of India's GDP. Reciprocal tariffs on India of 26% are lower than China, Vietnam, and Bangladesh. Now, the several sectors like pharma, solar, and copper are exempt from the new US tariffs. Second, crude oil and US yields are falling. Global fears have pushed down the oil prices and US bond yields as well. Now, this improves India's macro outlook. It reduces inflation and the current account stress. Our large import bill on oil offsets some part of the tariff increase, remember. Also, the government has increased the excise duty on petrol and diesel by 2 rupees each, which oil marketing companies will have to absorb. The government was quite swift on this front. On other macro point, lower US yields plus stable rupee is equal to more room for RBI for rate cuts. Third is the current account deficit. It is under control. It is just 1% of GDP, that is, experts flagged this as a strength for India. Strong services exports of 47% of the total exports helps offset goods trade weakness. India's forex reserves, import cover, and debt levels also show low external vulnerability. Fourth is realignment of global capital flows. With US equities underperforming, well, India could really become a capital magnet. Experts point out that Nifty valuation is making the risk-reward ratio more attractive for the Indian markets. The domestic investors continue the steady inflows, especially into the large caps. Now, the fifth point is mid and small caps are still expensive. Prashant Jain warns that risk-reward is unfavorable in the small and mid-caps universe. Large caps are better positioned to benefit from the macro stability plus the fund flows, experts point out. With that, it's a wrap on Too Sharp with ET. Thanks so much.